Hello, everyone. Welcome to another week live with Chaley. I'm your host, Larry Bailey, today, and it is May 17th, 2022. We want to once, as always, thank Ridge Lending Group for sponsoring these weekly meetings that we do. This week's topic is going to be about different loan programs that are available for different purposes. So in the spirit of open conversation, because we've got some folks joining, I will put this out to the group first to ask if anybody has any specific kinds of loan programs that you wanted me to drill into. And if not, I'm going to go through a couple of the more recent highlights. And I'm only laughing because in 1993, when I got my first start into mortgage lending, we had, I'm not exaggerating here, we had probably about 50 different lenders that you could go to. Again, this is 1993, so the context is very important. This is back when we were still using the thermal fax machines. And so literally every day, as rate sheets would come in across the thermal fax machine, I would take them to, sometimes they came in once a week, but whenever they came in, I'd take them to the printer, to the copier rather, and we'd come over and make sure that we had the most recent rate sheets, which had guidelines on there. So when it comes to lending, and just like anything else in life, there's a program, right? And so on the program, you have to meet specific guidelines. Everybody on this call has probably been, if you've been through any type of mortgage before, you know you have to qualify. And what's happening now, literally, is it's for those that are old enough like me to remember the early 90s and obviously in the early 2000s, where there used to be the mirror test, and we all swore that we'd never go back to crazy lending programs like we saw in the past, that those were just terrible ideas. The reality is right now that we're starting to see some peaks into that valley, some looks into that valley of just how crazy some of these lending programs can get. There's always been a conversation about how long will it take for us to get back to some really wild lending products. So here we are. We're starting to see some of them come out. If you're in the social media space, between mortgage bankers and loan officers and those kinds of things, we're all just kind of laughing. In the same breath, we're also saying, hey, as a borrower, does this matter to you, right? Does this program fit a need that you have? What's different about loan programs today versus 10, 20 years ago is that there is a conscious effort towards investors. And I think from my perspective, it could be that I just never paid attention to the investor side, because that wasn't really my focus as it is with Ridge, but it is front and center. Every loan program matrix that we review has a specific call out for investors, and obviously because they take a larger chunk now than they ever have before. So for those that are just joining the call, my question at the top of the call was, if you have you or someone that you know of has any need for like some kind of, you might call it exotic, but some type of loan program that's just not every day. So some of the examples of these exotic loan programs are like, I'm staring at another screen right now, but loans up to $4 million with using debt service coverage, including cash out refinance for non-owner occupied up to a 65% loan to value. So things that, again, seemed completely unavailable even just a few years ago are now out there for the taking, so to speak. So if anybody's got like a weird situation for a property or loan amount size, or again, if you've got, we've talked about debt service coverage, but I wanted to really spend this time to talk about some of the fringe cases, some of the extremes, and what this stuff means, because you never know. It might be somebody, that you heard has like a crazy need, and they're like, no, dude, you can't get a loan. Like, there's no way you're going to get a loan. And then next thing you know, they're like, yeah, I got the loan. And you're scratching your head like, why was that so easy for them? So if anybody has any requests or any questions about that, certainly feel free to take yourself off mute. If you want to type it in the question in the chat, go ahead and do that too. So this is going to be a talk presentation. If there's anything that I mention live with you now that you want me to dig into, let me know. If anybody's listening to this on the replay and you want me to dig into any specific guideline or program, let me know. I'll kind of go through the non-common loan programs just to talk about them. Some of these might seem repetitive because they might be, but there's usually a different take. So I'm going to talk about the first one right now, and that's over on the rate sheet. And so this program basically lets you go down to credit scores of 620. That I think is a standout, because most loan programs that you might have heard about will deal with credit scores that are, you got to be in the 700s to make it happen. Not always the case. So this one is a purchase or rate and term refinance, including non-owner occupied, up to $1.5 million. And the big part here is, if you can verify your income, and we'll talk about that in a second, but if you can verify your income, even down to a 620 score, you can do it with 25% down. But if you can't or don't want to verify your income, but the property debt service coverage is at least a 1.00, you put 30% down and you're golden. Even a step further, let's say the property doesn't fully cover its own debt service coverage, and it's at a 0.75 at a minimum up to 0.99, you can put 35% down. So I want to put this in context in real life. So you find a property, you got cash somewhere, you find a property that the mortgage payment is covered 100% by the proposed rental income on the property, up to $1.5 million, you can get that loan without having to worry about your tax returns or other income requirements. So in my brain, because the markets that I look at, I'd love to buy a house in in a Hawaii setting, Oahu specifically. I think there's some opportunities there right now. And so all I have to do is come up with $300,000, $400,000, and I can get that loan and let that work for me, using this kind of a product. So going back to the income verification. So in terms of income documentation, it's not only pitted in the qualifying of the income, but it also talks about reserves. So when we get in these high loan amounts, of course, cash is king, right? So in this particular case, it's looking for 12 months of reserves, right? It's to make sure that if everything else is true, at least you have a year's worth of mortgage payments in the bank, and then we can get we can get that loan qualified. Some of the other things that are important on this in terms of credit, I know traditionally, if you've got any blemishes on your credit, it's a no-go. On these products, these once we're old, now they're back new products. You can have lates on a mortgage. It just might reduce the LTV by up to 5%. So again, I'm bringing this stuff up because we don't really generally talk about, Chaley traditionally always talks about Fannie Freddie, and you might be thinking, or someone that might be thinking, I have to have perfect credit, or I have to have documentable income, or things along those lines. And it's just, honestly, it's just not the case anymore. So on that same product, again, to go from $1.5 million up to $4 million, again, including non-owner occupied. It's just, the context here. The difference is your minimum credit score is now at 700. So 620 up to $1.5 million, up to, let's see, then it goes up to $4 million. So above 3 million to 4 million, it jumps up to 700. Still not the end of the world for some folks. If you've got a ton of cash, probably have an okay credit score, at least 700. But that's really, I want to kind of draw out that one program just to spend some time to give the other side of the coin. Any questions on that? Any scenarios that have come up for you or someone that you know that you want to explore more on that? Let me know. Thanks for joining. And does anybody have, while we're on this call, does anybody have any questions about reverse mortgages or construction loans? Just curious if that's anything of any interest. Reverses in construction are, again, very unique products, not something that you may typically work with, depending on who you are, who your family is, but I can certainly speak to those if anybody has any specific questions. I'll go into like slight details, but so Sean, thanks for the question. All the products are 30-year question mark, but not all are Fannie Freddie. Yes, on construction loans, Donna, thank you. So Sean, no, that whole thing I just talked about there, definitely not Fannie Freddie. These are, again, I'm an old dude, so these are considered subprime loans. I know subprime became Alt A in the 2000s, and now they're not even considered. What do they even call these things now? Hang on, I'll tell you one second. They're called. They're just private. It's non Fannie Freddie programs is the best way for me to explain it, Sean. So all this stuff goes into, basically at the end of the day, all this stuff goes into private securitizations that get sold into mortgage-backed securities. So just to kind of spend 30 seconds, you borrow money, it gets sold to an investor or an aggregator, and that investor or aggregator then either gets it pooled together with other loans and delivers that to Fannie or Freddie, or what they can do is they can pull these together into what's called a security, and they can actually bundle that with an underwriter like a Chase, Goldman Sachs, Morgan Stanley, and they take it to Wall Street to investors to invest in the security that's got the backing of mortgages. That's, again, if you go back and read everything that happened in 2008, there's a lot of press on what is a mortgage-backed security and how does it work. These things are a derivative of that. They're an evolution of that experience, but definitely not Fannie Freddie.
Thank you.
Yeah, you got it. Thanks, Sean. All right, so Donna, thanks for the question on construction. I'm going to talk to Denise, your question about downsize to reverse mortgages for seniors. So I got introduced to reverse mortgages like full on. I was helping people with reverse mortgages in 2007, 2008. And there's only a couple, and I got involved with it because in New Jersey at the time, it was got a really, really bad rap. There was, I forget the dude, it's like, there used to be like in the Northeast, there used to be like these TV commercials, and I forget the actor's name, but it's like he was all about selling reverse mortgages, and it was this whole big thing. And what was happening was you were getting paid a lot of money as a loan officer for delivering a reverse mortgage, and nobody was spending the time with the seniors and their families and their financial planners to really explain what it was. So what happened, a reverse mortgage, for those that are not indoctrinated here, is you have to be at least 62, and you have to have typically at least 20% equity in your home. That's a I don't know, Sean. I wish I could see the actor. He was like a soap opera star. I wish I could remember the guy's name. Anyway, so what happens with the reverse is when you sign the mortgage, it's a mortgage, it's just a regular mortgage. They send you a check every month. It wasn't Tom Selleck. I wish I could remember the guy's name. And they send you a check every month. And what's happening is the principal balance grows and the interest accrues because you're not paying the mortgage. The mortgage is compounding interest. And you can, it's an open-ended mortgage, so you can pay it off whenever you want. There's no penalty. You can sell the house. Robert Wagner, thank you, LQ, Robert Wagner. That's it. That's the guy's name I couldn't remember. There you go, Robert Wagner. Thank God for Google. And so if I had a house in 2000 worth $300,000 and I took a reverse mortgage out, I owned it free and clear. And I took a reverse mortgage out and I started getting a check and I sold it today. And now my house is worth 600,000 and I owe a $300,000 balance. I'm going to sell the house for 600. I'm going to get $300,000 back. Plus I get to keep all the money that I received because that's my money and it's non-taxable. So, so what was happening was usually it was family, usually it was kids would get really upset that their parents took out this really bad reverse mortgage because all their inheritance was going away. The financial planners were freaking out because they were like, oh my God, this is the worst thing ever. You're not going to have any money left over after you die to distribute to your heirs. And I would sit there with folks and I'd say, are you, and this is honest to God, I'm like, how's your food situation? Are you paying your bills? Can you afford to stay in your home because you're on fixed income and your fixed income no longer pays your taxes or pays for your car or your gasoline? Like these are honest to God, real conversations. And I'd pull in the family. I'd be like, are you giving them money every month so that they can pay their bills? So that you can get their house after they die? Like this is, again, if you haven't learned already, I'm very direct, which is why Chaley and I get along so well. So reverses are to go back to your original question, Denise, the downside to a reverse mortgage for a senior is they don't need it. That's the downside. It's an uneducated consumption, meaning when do you need a reverse mortgage? You want a reverse mortgage because you want to actually receive money from your house every month tax-free until you die or until you vacated the property for 12 months, right? So if I did one on my house, if I was, 62 or older, and I did one on my house, if I lived somewhere else for 12 months straight, I would have an obligation to pay back the reverse. That's what the mortgage says. Or if I died, and I was the only one on the mortgage, again, 12, it's once that 12-month hits, the loan has to be repaid if the house wasn't sold sooner. If it's me and my wife and she's alive after me or vice versa, if she dies and I'm alive after her, the note goes on. And again, we keep receiving this fixed amount until we're no longer in the property for at least 12 months or we're dead. So the downside is, again, education, Denise. The downside is you don't really need it because it's not a money play. You're borrowing against your house. The interest is compounding. So you only want, it's not something where you're like, oh, I'm just going to go to get the free ATM card out of your house. No, that's not a good application for it. So the other downside is if you work with, again, if you've got a financial planner or somebody who's advising you financially, the downside of getting reverse is you haven't explored all other options before you make that decision. It's an expensive loan. And, it's not something you just want to enter into because it's expensive to originate this thing. But hands down, like everybody said, if you don't subscribe to this, I understand. But if you pay off your house to plan for retirement, and then you don't have enough money coming in every month to pay for the taxes on the house that you planned for retirement, and you lose the house to tax sale, what the hell did you do? Like, it's just, and this really happens, like it's real. So that's what You can tell I'm passionate about this thing because I know plenty of seniors who have income situations and they want to, all they want to do is stay in their house. And this is a way for them to do it and get cash every month reliably to pay for their living expenses while they're alive. So hopefully that helps, Denise. If you want to talk more about it afterwards, be certainly happy to talk more about it. But and there's plenty of literature. Ask Robert Wagner; he'll tell you all about it. Thank you. Thanks, LQ. All right, we'll go back to construction. And for those that are just coming on, if you have any questions about loan programs, we're just kind of I'm talking through some of the loan programs that we really haven't covered before. So construction, there's two kinds of construction loans. Two kinds of construction loans. There's a 2-close and there's a 1-close. A 2-close is when you get a loan that's specific for the construction, usually a 6, 9, or 12-month term. A lot of times it's from a local bank or a credit union. I found those are absolutely some of the best construction lenders in the country, is your local credit union, your local bank, because they love to get that money out and they love to get that money back and then lend it out again really quick. That's, churning money is the quickest way to make money for the bank. What they don't like to do is a long-term mortgage because it sits on the books and it's kind of slow. It's a slow trickle of cash. So they would love to do a 2-close. And typically what we'll do with a 2-close is we'll approve you, get you a commitment or an approval subject to the home being complete, give that to you, give it to your banker. We'll work with the banker to make sure the conditions are updated, keep progress for that loan. For those that have never done a construction, typically the construction is broken down into draws or periods of disbursement. Depending on the size of the construction, it could be as few as 4 or 5 draws. It can be as many as 10 or 12 for an extremely large project. But basically the 2-close is a refinance technically of that first mortgage, taking it out into permanent financing, and you're done. So there's the magic for that 2-close is working with the local, hi Eddie, is working with your local lender while having Ridge get you the approval for that takeout to give your local lender comfort. Now the 1-close is called a one-time close. And the reason why it's called a one-time close is because as a lender, we'll go through and make sure that you have all of that initial construction money and the permanent money actually closed at once. At the time of initial closing, you'll still have draws. It's a little bit more complicated than a 2-close, believe it or not, for the construction part, because you have to do a lot of this pre-work done. We have to make sure that the contractor gets approved, and we have to make sure your plans and specs are done, your architects. And so stuff that your local lender may not be so stringent over because they know your area, they might even know the builder, that kind of a thing. We may, but it's more likely we won't know those parties. So we're going to put a little bit more due diligence into that one-time close for the construction period, because we're just kind of getting to know who you're working with. And there's risk in that, right? There's risk in the builder going under. There's risk in delays with the local municipality for permits, all this stuff, because you're still on that 6, 9, 12-month clock to get the house done. So on a one-time close, it's a very specific product. It offers, typically the premium of that permanent financing is a little bit higher than if you had the house completely finished. But what happens is, instead of having to close on a refinance of the construction money, it's called a modification. So when the house is completely done, the appraiser goes out, title company certifies that there's no additional mechanics liens against the property, no judgments, anything like that. The appraiser says, yep, it's done. It's still worth this much money. Everything's good. And then it's recorded modification. to take you from your construction loan into your permanent financing. So it's not complicated. There's just steps, and communication is critical. Organization is critical. Not changing things in the middle going, oh, I decided I wanted to change the way my house looks or change how big it is or how small it is. Yeah, no, it's not a good idea. So that's the vibe on construction. Donna, did you have any other specific questions about that? Eddie's got a comment here. Says, with millions of new construction homes underway to hit the market, and Fed is ramping rapidly interest rate, what is my take on when those new built might hit the market? As soon as they're done, Eddie. I don't mean to be flippant about your question, but interest rates have nothing to do with how quickly houses can hit the market. Builders would pay gobs of extra money if they could afford to bring in people that don't exist to finish these housing developments. We are, last estimate, we are 2 million houses underserved in the market right now. That's the best estimate, and that's presuming time stood still right now. Population growth continues. Housing shortages are still a thing. What's a bigger problem, Eddie, is housing affordability. So I can tell you, in a town that is not far from me, new construction houses, I'm not exaggerating these numbers. It's a stupid 3,000 something square foot house, $750,000 to be 15 feet from your neighbor, and paying $15,000 a year in property taxes. I don't know who these people are that are affording that or who are deciding to afford that. But if, if they had a choice, these people probably wouldn't do it, but there's no other houses available. So the builders are popping them up, and as soon as they're able to be sold, they're sold like hotcakes. So, Eddie, my answer for you is, I don't care if the interest rates go to 8. It's not going to change the housing market. It's just going to make it a situation where, maybe the financing needs to get a little bit more creative, or maybe more than one family will invest into a single house. We've seen that before. So hopefully that answers your question. So on that topic, let me see if I have time for one more kind of weirdo product. Let's see if I can find one. We talked about reverse. Specialty properties. I don't know if that's a thing anybody cares about. I know I did a thing up before about a 203K. That's a rehab loan. Maybe I'll talk about, because we're all doing investor stuff. I was going to say down payment assistance. That's been coming out quite a bit. We talked about reverses, second liens we're not doing, and second liens we're not doing, jumbos. Yeah, it looks like everything left on here is either jumbo or just another example of a non-qualified mortgage, which is that kind of like what I was talking about at the beginning of the conversation here. I will kind of end on the idea of a, where was it over here? Sorry, gang, what I'm looking for. That was the construction, that was the non-QM, specialty properties, thank you. This is my mind today. So if you've got, this is just a general statement, as you're looking at properties, again, I'm in New Jersey, it's not totally unusual to see something unique. In my marketplace, a unique can be a 2-unit condo. If you've never seen a 2-unit condo, take a trip down to the Jersey Shore, you'll see them fairly regularly. And what that does is it creates an appraisal issue because the appraiser needs to find comparables, right? And so if you're not used to dealing with a 2-unit condo and you don't know of any other houses that have sold recently to support that value, you could be into a situation. Some other examples that we've seen recently are excess land. So again, for those that are in an area where maybe land is more abundant than not, if you've got more than 10 acres on a piece of property, make sure that the value of that home is not excessively geared towards the value or the perceived value of the land. A good rule of thumb is 20%. Some programs will curtail that or make that smaller than the 20%. So yeah, if you find a property where, it's $1 million property and, the house is worth 100,000 because that land can be subdivided and that kind of a thing, that might be a good application for a commercial loan, but it's not going to make a residential loan happen. So that's one. And the only other one I can think of really that is, it comes up again, at least in the Northeast. I don't know if this is prevalent in other places, but things like geodesic homes or uniquely designed homes in terms of either construction material or the physical construction of it, like in other words, a look and feel, that kind of a thing. Just be aware, again, as you're looking at houses and investments, if it's a unique property, it could lend to underwriting issues of the file. So naturally, if you ever have any questions, you can always send over a link. We'll be glad, send it over to info@ridgelendinggroup.com, and we'll be glad to give it the once over and check it out to see if there's anything that we see as a concern. So any other questions from Donna's got a question. Thank you, Donna. So you're working on purchasing property, 140,000 low. Were you surprised? Like, again, not looking at the appraisal, obviously, but 140,000. When I see that kind of a situation, my personal history is the home that I'm buying, I'm expecting, based upon the neighborhood where the house is, it should be worth more. Again, I have no idea about your situation. I'm going to talk about what my experience has been. The problem is the appraiser does a statistical analysis of the zip code where it is, and the appraiser says, but I found one over in this other neighborhood, same zip code, but totally same house, different neighborhood. Like in this town I was telling you about that's not far, if you were in Sherwood Forest, you were higher priced than if you were in Tamarack, directly across the street from each other, but it was more prestigious. And it wasn't racially, no, it was the same town, same demographics. It was a local event, because if you could live in Sherwood Forest versus Tamarack, you are more well off, and people paid more to be in this community. So I don't have any idea what's happening with your situation, but I would look at the comparables, right? So I would look at the comparables. I would try to understand without emotion why the appraiser chose those properties over other properties that you might have chosen as a comparable. But the appraiser's responsibility is to protect the lender, not you. It's the appraiser's responsibility to find what they feel is the most likely comparison. If the lender has to take that house into foreclosure, what should they expect to get? That's the purpose of an appraiser, is to protect the lender. And if the lender has to take that house into foreclosure, what are they expecting to get? So I don't know if you want to have any, I don't know if you want to talk about it now or if that's helpful for you, but our remedies, right? As a borrower, our remedies are to request a second opinion, to look for factual mistakes on the appraisal, and to supply alternative comparables. The appraiser has no obligation to do anything other than respond to a factual mistake on the appraisal report. So other than that, it's your guess as good as mine. Yeah, so Nancy, you're 100% right. There was one in the news earlier this year where a family, it was a Black family in I forget where the area was in the country, honestly. And what they did was they had a sting on the appraisal in the appraisal industry, and they put a Black family, and then I think it was a white family in the same house at different times, and the values were ginormously different. And I never heard the reporting of what was involved after that, but the reporting at the time was sensational that there was such a big disparity based upon who the appraiser saw at the home, so it seemed, at the time of the inspection. But I don't know if there's any more information about that, but it should never, appraisers are licensed, and they take thousands of hours of work to go through apprenticeship, because their opinion of value obviously can affect people's lives. So that's not supposed to happen, obviously. So I hope it was figured out, and if they needed to have their license revoked, I hope it was revoked. So Donna, hopefully that's helpful for your question. But yeah, Nancy.
Yes, very helpful.
Yeah, I've been there. Not as much as that number, but I've been there on a purchase, and the remedy that I exercised at the time on one deal was to cancel the deal. And I said, listen, we don't qualify for the mortgage anymore. Have a nice day. I took the mortgage clause out, and I exited the file, got my deposit back. The second one, we actually argued a little bit, and it didn't affect the deal. It was just a difference of opinion, and I chose to move forward with the transaction because I appreciated what the appraiser said, but it didn't change my mind, and it didn't affect.
So you got to talk to the appraiser?
Not directly, and again, this is way back before HVCC, and then current standards are appraisal independence requirements. So no, I mean, this is going back a while.
Okay.
I'd say 15-ish years, 2007-ish. And remember, I'm in lending, so I kind of would break the rules because, I know the appraisers. But the point is, today you can indirectly speak to the appraiser through Ridge Lending, and we have to go through the appraisal management company if we're using one. And it's a very transactional conversation, like, hey, we noticed this. We know, we're requesting a review based upon these facts. We're requesting a response based upon these other comparables, and you get to, end of that conversation one way or another.
Okay, that's helpful. Thank you.
Yeah, you're welcome. It's always surprising. I mean, as funny as it is, again, 20. Whatever, it's been 28 years in lending. It always struck me as odd that the appraiser said they needed a contract of sale to do their appraisal. And the feedback was always because they wanted to know what the sale price was so they could match it. That's not really what they're supposed to be doing. They're supposed to be protecting the lender. And so, I always say, we have enough technology these days to give you a good sense, but you can always still be surprised. So those steps after you get the report, if you're surprised by the results, there are steps to kind of get to the bottom of it. But ultimately, if the appraiser decides their opinion of value is what they believe, and there were no factual mistakes, then you got to make a decision from there.
Okay.
All right. Exciting stuff. As always, thank you very much. If there's no other questions, I'm going to give everybody the rest of their day back, and thank you very much for attending and listening in. And every week here at 4:30 p.m. Eastern and 1:30 p.m. Pacific, we between Chaley and myself, we try to give you some information and take time to answer your questions. So thank you very much for coming. Take care, everybody. Thank you, Nancy. Take care. Bye-bye. Thanks, Eddie.
Thank you.